gentlemen, thank you very much for joining us on what has now become our weekly Vantage webinar. And the idea is to try and bring thought leadership, to try and bring what's happening out there in the world to us in the most direct possible way. And we, as I think everybody knows, have an incredibly good relationship and long-standing relationship with 91 Asset Management. And we've been able to I think a lot of Octagon has been built on our relationship with 91 Asset Management. And in particular, with Siobhan Simpson. Siobhan, inter alia's job is to bring the pearls of wisdom of the likes of Sumesh, Chetty, and other asset managers at 91 directly to us as advisors and by extension to you, our clients. So the idea of these webinars is to try and expose you to what we are regularly exposed to get it directly from the Sumesh Chettys. Sumesh runs, together with Claude Rousseau, an all-time favorite of Octagon, and they run three funds, the Cautious Managed Fund, the Opportunity Fund, which anyone who's my client has definitely heard me going on and on and on about the Opportunity Fund, and they run a brilliant fund overseas called the Global Franchise Fund, also a firm favorite of the Octagon Group. So it is a great pleasure today to be hosting Siobhan and Sumesh as they speak about what's happening in the markets both South Africa and around the world. And these are not just other fund managers, but quite frankly are certainly amongst our top most loved fund managers. And in particular, the move recently that Octagon has moved into, we've made some very strategic calls to try be more in what we call quality asset managers or quality managers. Is that this is the different styles of asset management, and one of the styles is quality. And we believe that navigating our way through this incredibly challenging time, we believe that the best play right now is to follow the quality managers. And so before I hand over to Siobhan and Sumesh, I just want to go through some housekeeping. When we start, I'm going to continually monitor, make sure that everybody's on mute, and if you could just monitor that yourselves. Video is up to you. You can leave it on or leave it off. But what will happen is that there's, at the bottom of the screen, there are a whole lot of icons. One of them says chat. And in the chat, you can chat all the way through. It won't disturb anybody. It won't be disturbing the speakers, Siobhan and Sumesh. What we will do is watch for questions over there. And as questions are increased, we will collate these and ask them to Siobhan and Sumesh at the end. So all of this information will be there. We've got a saying that when it comes to webinars, 3 is 2, 2 is 1, and 1 is none. Because at some stage, somebody is going to go offline for a second. And so I'll act as like a backup to Siobhan. And if Siobhan does drop, I'll continue asking the questions to Sumesh. And Sumesh, you've got no choice. You can't go off. You've got to stay there. Sorry, buddy. Okay, so without any further ado, ladies and gentlemen, Siobhan and Sumesh.
Thanks, Menachem. I'm just going to share my screen so that I do have one or two slides that I want to show Sumesh and then ask his opinion on. So in today's Q&A, what we're going to do is we're going to focus the session around Sumesh and where his team are finding opportunities. But I think in today's environment, we have to touch on kind of the background, coronavirus, COVID-19, and just assess kind of the lay of the land a little bit. So I think, the picture that you're hopefully seeing on the screen at the moment really shows us how it's what we felt since the beginning of, for us, really towards the middle of March. Essentially, I think you can break it down into 3 elements: a health crisis, which led to an economic crisis, which could and had the potential to lead to a financial crisis. Now, when we talk health crisis, none of us are doctors, as much as we all think, because we have been schooled on Twitter and read enough articles on the internet, we're all epidemiologists and we have this ability, but we aren't. We're going to spend less time here, and Octagon clients heard from Frans Cronje a few weeks ago, and so you'll have that expertise in the background as well. So I think it's better for us to focus on the economic and financial impacts of COVID-19, given that is Sumesh's more speciality than a health crisis. So just to start off with, the economic impacts, and to avoid this financial crisis, there's been this unprecedented amount of stimulus. And what you're seeing on your screen at the moment is essentially the Federal Reserve, the US's stimulus. And that has propped up markets. They've been trying to avoid this utter collapse. But by doing this, there's been a lot of debt that's been created. And my question to Sumesh, to start it off, is, do you think this is enough to avoid a financial crisis? And ultimately, who pays for all of this debt that has been created?
So, thanks, Siobhan. Look, not easy answers, obviously. So there are a couple of things you've got to take away from this. Number one, the reaction function of central banks has been immense. A lot of lessons were learned after GFC. So what's very interesting about this graph, obviously, this is the US Federal Reserve's balance sheet. It was about $1 trillion before you went into GFC. And it had been increasing very steadily. Like if you go back to, I think it's the late 90s, the balance sheet was only about $500 billion. So between the late 90s and 2008, you went from 500 billion to $1 trillion. Then overnight, like in a month or two, that ramped up to over $2 trillion. Now, at the time, that was shock and awe to us, right? So that's a big move. But clearly it wasn't enough, because even though it prevented businesses from going bankrupt, I mean, obviously the Fed, unfortunately, and Treasury did let Lehman's go, and that was a big mistake. But ultimately, the crisis was such that it required even more stimulus. And what's fascinating is that this continued to ramp up. I mean, so the previous peak was actually 2013, as more and more stimulus was required. So the markets were hooked on stimulus. And so
those were all those QEs, eh? The quantitative easing.
Quantitative easing, QE1, QE2, QE3, right? And so now you've got the initial stimulus. So the Fed has learned this is what you need, because they don't want this morphing into a financial crisis. But we don't think it's the end, because this is the first step. And there have been commentators in the market saying this thing could be $12 trillion by the end of the year, because this is what they're doing. They're keeping markets afloat. If it weren't for this, markets would be in the toilet, frankly. And you would probably also see a lot of institutions, financial institutions, going bankrupt. We're going to see the bankrupting of a lot of institutions as it is. The bankruptcy index, the Chapter 11 index in the US is rising quite rapidly. But the point here is that you just don't want the entire system to fall over. Who pays it off? Well, our grandkids, unfortunately. You're going to be slaving away, trying to pay back all of this debt. You might be in a situation where the Fed continues to monetize the debt. And I mean, that means buying debt directly from the US government. They're going to have to keep interest rates extremely low to ensure that affordability is in place. And that also means that the real risk to all of us is that inflation actually comes back, and it comes back quite strongly. In a lot of instances,
likely is that inflation? I mean, we haven't really seen inflation since global financial crisis.
No, we haven't. And I mean, that has to do a lot with the demographics, the lack of demand that's occurred. And then, of course, the fact that you've got a sharing economy that's actually reduced prices across the board. Look at what Airbnb has done for hotel prices, Uber has done for transport prices. And then over and above the sharing economy, you've got businesses like Amazon that have been slashing retail prices. So, you've seen retailers going out of business in the US and margins really coming down. So I guess in some regards, inflation is actually positive, because it means a lot of economies can grow their way out of their debt to GDP problem. So look at what happened after World War II. Debt to GDP, I think in the UK, was like 250%. But given the strong inflation that they saw thereafter, you saw that problem actually shrink away. So inflation would be a little bit of a positive, and I think that would encourage central banks to actually keep those interest rates low. Coming back to your point about repayment, it's grandkids, and the part I left out that's really difficult on this one is you're probably going to see in economies where you don't have a reserve currency like the dollar, because remember the dollar has the world's printing press, or the US has the world's printing press in the dollar. You're probably going to have to see debt restructures, debt forgiveness, and most likely in the weakest of the EMs, defaults.
Oh, yikes. Okay, let's get on to the potential for South Africa for that one a little bit later. I'm going to shift on to the recovery, and hopefully it comes at some point. But the stimulus obviously has been to avoid a deeper recession. But when we look at this, every day you hear a new alphabet letter that the recovery could be. And on the left-hand side, I've just put a few of them in there. And everyone was expecting either a U or a W. Very few people expected the market to rebound like it probably has. What's your opinion as to the path that we take out of this?
Okay, so you got to be careful. You got to distinguish between what the market does and what the underlying economy does, right? So the market's reaction function is going to be one where investors or speculators or however you want to think about people putting money into the market are going to try and front run what happens. And that's a large part of the huge rally that we're seeing over the last couple of days, because there've been some economic indicators that have been a little more positive than people expected. And now you've got economies opening up and people assuming, well, if the economies open up, even though you're at potential risk of infection, if you don't appropriately social distance, you at least get back to trying to drive some sort of economic growth. So the market's trying to front run that. When you look at the shape of a potential underlying economic recovery, we're not bears and saying it's L, that, this thing's never going to come back. We're in the U camp, but we think it's a very wide U camp. And the new kind of recovery lingo that we've kind of taken to, we heard someone use it. It's not even a letter, it's the Nike swoosh. And we think that that's probably the most likely, that you have this very sharp downturn, and the sharpest element of that downturn will be Q2 of 2020. We think that's when the GDP numbers are really going to crater, and a slow, gradual recovery thereafter. The question you've got to ask yourself is, everyone on this call, what needs to happen for you to feel comfortable to go back to living exactly the life you had in 2019? Exactly that life. Getting on a plane, going to a restaurant, standing in a line for something, going to a concert, going to a live a sports event, wherever you've been in touch with people, hugging a stranger, kissing a stranger on the cheek, shaking their hand, and you think about those implications. You probably want the vaccine, or you want to know that you have the antibodies in your system already. And then when you think about it in that way, it's like, okay, how long is a piece of string? Siobhan's already said we're not that word, sorry. But maybe someone accidentally discovers the vaccine today. Who knows, right? Maybe they discovered in 6 months, maybe it's 12 months, maybe it's 2 years. I don't know. But here's what I worry about. How are we going to manufacture the volumes that we require? How long does it take to manufacture those volumes? How do we get those volumes out to the countries most in need? Who gets it first? Is it 12 months? Is it 2 years after we find a vaccine before we all feel comfortable enough to get back to what we're doing?
And what I've got for you later, and you can think about it in the interim, is a question about what companies benefit in the interim. So you can think about that while we move on to something slightly different. And here's one for you, George. Last year, I want to quickly touch on the US-China troubles and the tensions there. The end of last year, we saw a big run, something different to coronavirus, a big run as a result of this potential deal that they've reached, a phase 1 deal. But the tensions seem to have escalated again. Trump's been blaming China for the virus. More recently, obviously, Beijing has passed a law with regards to a security law on Hong Kong, which threatens their independence. So just your opinion on the likelihood that these tensions actually start to affect the market a little bit more going forward again, given that COVID, the market seems okay about it. I thought, when was it, last week or 2 weeks ago, when the security law from around Hong Kong was announced, I thought that we'd see an extended weakness in the market as a result. But
No, I agree completely. I expected that same. Well, I expected a reasonably short initial sharp pullback and then some form of extended weakness. Because if you cast your mind back to back end of 2019, Hong Kong riots, and then what we suffered over 18 and 19 in terms of trade wars, I thought the market would take this far more seriously. But Trump was relatively benign when it came to his reaction function. Everyone was expecting bad news over this past weekend, and it never came. And I thought China was brilliant in terms of taking advantage of the COVID situation. We were all looking at this, and we were all thinking, like, never let a good crisis go to waste, wondering what's going to happen. And China is the one who actually pounced on that kind of that sentiment by saying, okay, let's increase our stronghold over Hong Kong while people have restricted movement, because people are going to find it difficult to protest. You're not going to want to get infected. But what actually surprised me the most was China coming out and saying to some state-owned companies, don't buy soft commodities from the US, don't buy soybeans. So remember, as part of the trade one or phase one trade agreement, China had to buy a lot of soybeans from the US, and now they're stopping to do that. I expected markets to look at that and say, hold on, this is massively risk-off because the trade war comes back. But I guess what a lot of people are wondering about is how effective can Trump be, given that economic growth is already on its knees? His primary constituents are going to be the ones that are most affected. So when you saw those 20 million job loss numbers in the US, it's not the highly qualified professionals sitting on the East Coast and the West Coast. It's going to be the guys in Middle America and the guys doing the really entry-level jobs in the rest of America. And so
you need to vote for him in
exactly.
November.
Right. So what's the weapon at Trump's disposal? Trump says, oh, I'm going to increase tariffs and we're going to get more money into the US. But you're not getting more money into the US. You're taking more money out of the hands of US citizens. That's what tariffs mean, because you're charging US citizens more to buy those imports from China. And it's an election year. So I think there's only so much.
That's why he's almost a little bit weaker on the stance, on his start, the Hong Kong scenario. He actually needs the markets to be up.
Well, he does, because that's how he measures his success. And he's getting a little bit of that. But now he's being attacked on three fronts. So he's got COVID, and I think his reaction to COVID was very, very poor. I mean, he poo-pooed it. Some of the way he kind of addressed the medical and scientific discoveries, I think, was inappropriate. Now he's got China, and he's got domestic problems within the US right now over the fact that, citizens are up in arms over police brutality and George Floyd. So
he's got a lot to deal with.
He's got a lot to deal with, and frankly speaking, I mean, he's an idiot. So you don't have a brilliant president. Pardon?
You're going to make Menachem angry and George very happy.
Okay, I'm going to shut up.
Okay. Maybe we shift to South Africa now, which is something that's obviously it affects all of us when we talk coronavirus, our lockdown, and our stimulus package, and then we'll move on to some investment opportunities. So our growth was really weak going into this crisis, and we know that the impact of the lockdown will be severe on SA growth. I mean, Menachem mentioned a poll that we did on our webinar on Tuesday, and there was a lot of people who actually thought that it could be worse than minus 10%. So just in your opinion, how much damage is done? How much, company failures, job losses, it's all becoming very real. Just your opinion on the lockdown, and what would you have done maybe differently to Cyril?
Let me start with what I would have done differently to Cyril, because it's an easier question to answer, because there isn't really an answer. It's tough. I think we're all too hard on Cyril because we're still angry post Zuma. And as a result of that, I think Cyril bears a lot of that. I think, Cyril's turning a ship around, giant ship, and it's hard. And it's very difficult because what Cyril is balancing is he's balancing lives against economic growth. And what makes it worse is the majority of the population does not have the ability to social distance. So it's fantastic we're sitting in the suburbs and going, oh, but this is wrong, that's wrong. What he's trying to do is he's trying to ensure that the populations that are living in townships are actually the ones who are safe. And then it's very difficult to apply different rules to a township and to, let's say, a suburb, a very wealthy suburb. Because, I mean, clearly, given the imbalances pre-1990, that's not going to go down well, because that's immediately going to become a race issue. It's going to become, oh, white people are allowed to do whatever they want and black people are being oppressed. This is apartheid all over again. So I think there's a lot of difficulty there. And we can at least say that Cyril is a very economically aware president. So he knows the cost either way. It's labor and lives versus economic degradation or distraction. So very hard to call. The one thing I would have
got stronger within. Sorry, Sumesh, just to interrupt. Do you think he's got stronger within the ANC, or through this crisis? I mean, that was the kind of impression right in the beginning, but obviously there's been a lot written around the Zols and various other things.
So I'm probably not the best person to ask about that, but I'll give you my opinion. I don't think he's gotten stronger yet. I think he will get stronger. And I think he hasn't gotten stronger because of his inability to rein in that crisis council. And what worries me is that a lot of decisions have been made by that council that I don't think were logical. So you see that the courts have actually said, okay, you've got this 14-day standstill, and then you've got to be able to justify why some of the regulations are as they are. So smoking doesn't make any sense to me. That's the bug. Everyone's bugbear. Alcohol, I could understand. That you can't enforce social distancing if you allow the sale of alcohol. And I think a lot of South Africans got behind that. I mean, if you look at how good South Africans were in the first 3 weeks of lockdown, but starting to implement things like, oh well, you can only exercise between 6 and 9, not taking into account what time the sun rises in different provinces. I think people just got irritated there. So we were all really happy to get behind Cyril to do our bit. Because you think about it this way, right? At no point in history has so little been asked of so many to accomplish so much. So you think of what would have been asked of me before World War II. It would have been like, sorry, buddy, here's your gun. You weren't in the army, but you're going to potentially give your life for your country. Now Cyril has said, Sumesh, sit on your bed, watch Netflix, read a book, do your bit for your country. And I'm kind of going, how hard is that? That's fantastic, Cyril, I'm in. Oh, and you can't drink whiskey and you can't drink wine unless you already own it. I can deal with that, right? If he told me to do that for a year, I can deal with it. But I think a lot of South Africans could. But I think what frustrated people is the inability to justify things that were really stupid. And I think that's where he's lost a lot of credibility. But I think what will ultimately happen is if you think about the structure of the government, there was supposedly a lot of internal fighting, a lot of factionalism. And off the back of that factionalism, it meant that, Cyril had to play peacemaker, bring people onto the same page, and ensure that, he could get the appropriate amount of support for the policies that he wanted to make, the structural reforms that we require that haven't happened. But now with the economy on its knees, people are going to be very aware that they just can't get what they were looking for before. Because if they continue with these demands, forget no increases or decreases, there aren't going to be jobs. You can see what's happening with the SAA. You see the reality of social distancing in minds. I'm sorry, Siobhan.
So it's given him more power with things like wage negotiations.
Exactly. And I think the one silver lining for Cyril is that structural reform might be easier to implement post-COVID than it was pre-COVID, but we need to watch that carefully. Because if he doesn't have the ability to do that, well, then he's weaker, potentially.
Yeah. So what areas of the market are going to recover the quickest? Kind of what would be your investment opportunities that you're looking for in South Africa?
Okay, so investment opportunities in South Africa relate to those businesses. The number one will be the least impacted, or number two were the most prepared, not because they were worried about COVID, but because they were worried about the deteriorating economic situation. So if you take a look at the banks, for example, everyone likes looking at the banks. Clearly debt in this country is high. Credit loss ratios are going to be high post this because of job losses. You're very worried about where growth is going to come from, and it doesn't seem like a sector you want to invest in. But given that 70% of capital under Regulation 28 has to be here, you need to consider the banks. So we would always say invest in the stronger balance sheets rather than the weak balance sheets. The valuation becomes more attractive. You want the First Strands, and you want the Standard Banks of the world. You don't want the Nedbanks, and you don't want the ABSAs of the world. However, if you think a year out, the world is going to go back to normal, South Africa is going to be perfectly normal, then the weaker stuff in the market is where people get the most excited because they think, oh, well, this will recover the strongest, or it'll give you the biggest bang for buck because it has been so unloved and it's been completely messed up by what's going on in the world today. So you see these 70% collapses in prices versus the 30% collapses in prices. But when we think about it in that context, we think like, okay, you're actually gambling a little bit. You don't want to do that. And so you focus on the stronger balance sheets, the better quality companies. Now, those are businesses that are going to survive. They're going to do well, but they may not necessarily thrive. When it comes to businesses that are going to thrive, what we think about is, well, what changes? How does consumption change? So, already hearing stories.
I'm going to pause you there because I've got a slide just now and I want to show it to you and ask you.
Okay. So,
So higher quality sort of businesses that are able to weather the storm is where you'd park your money sort of for the time being.
Well, one element of it, and then you also want businesses that are going to succeed and thrive off the back of this. Think online, think
this
digital.
Enormous stimulus package that we've had. I mean, 10% of our GDP, 500 billion rand. I think if I've got the numbers, seems like a lot of money. And we've seen plenty of articles now around the fact that we need to go to the IMF and the BRICS Bank and all these places, which sounds scary. You spoke earlier about EMs essentially defaulting. What's the potential impact here for us? Are we the next Argentina? And how does our bond market behave as a result?
Okay, so let's start with I don't think we're the next Argentina. Not in the short to medium term. You do have to watch structural reform very closely, but we're not the next Argentina anytime in the near future, right? Number two, we will have to go to the IMF, but remember that the IMF has multiple loan facilities, and for crises like COVID, there's a loan facility that doesn't come with very onerous conditions, right? I wouldn't worry about that IMF loan facility. Third point, actually, this should have been the first point. I don't think 500 billion is a big stimulus package. It's very difficult to fund. And, when you look at the breakdown of the funding, I mean, we're still waiting for all the details, but some of that was coming out from places like the unemployment fund, and the unemployment fund would have been used in this environment anyway to make payouts to people who are going to be retrenched or are going to be unemployed. Longer term, what we worry about, of course, is this ballooning debt to GDP. So let's put structural reform aside. Obviously, the fiscal deficit increases. So the fiscal deficit, you're expecting about 6-7% this year pre-COVID. Now could be anywhere between 8 and 12%. Let's just call it 10%, and that's something that we can't fund because, or it's ballooning because you have lower collections. So there's this conversation around, do we increase tax rates? But of course, tax rates can only go up so far before people say, well, we're not getting any bang for our buck. And
the wealth tax.
The wealth tax, for example, or even increasing the top tax bracket. The top tax bracket at 45%, I think the government is going to be thinking about pushing it further, or raising dividends tax or raising capital gains tax, because there was an argument many years ago that suggested that dividend tax and capital gains tax should be equivalent to income tax, because it was only the rich that were benefiting from dividend tax and capital gains tax, and it just allowed the wealth gap to increase even further. So when I think about the IMF, obviously it's not great. Countries are against it, populations are against it, and I feel a little bit uncomfortable discussing this because I think I would be for it, and I would be for it because it would force fiscal prudence. You would have to cut costs. But in cutting costs, in cutting expenditure, remember, we're a consumption-led economy. Our economy is going to be on its knees. Growth is going to be negative. I mean, GDP growth per capita in this country has been negative since 2015 anyway. And we're going to see negative growth this year overall for the entire year. We're not going to rebound this year. But IMF funding is going to make that materially worse. And we're all going to suffer off the back of it. But when do you take the pain? You have to take the pain at some point. If you are unwilling to take the pain, then you need to grow out of the problem. But the government seems unwilling to spend money, or I guess it doesn't have the money to spend on growth initiatives. Most of the budget is actually used on salaries, government salaries, on social security, and then of course on debt repayments. So I worry about our ability to grow. I don't think we have the policy in place. There's still uncertainty about property rights in this country.
You are painting a very negative picture right now. And now I'm about to go on to a section where I want to ask you the investment opportunities. I don't think we're going to have anyone left on this call soon.
No, it creates fantastic investment opportunities because people are so negative about this. But the investment opportunity, I think, is not what everyone's assuming. But I mean, Siobhan, it's I think there are fixes. We have a lot to offer. Tourism, I appreciate it's going to be hindered or impaired for the next couple of years, but South Africa is a beautiful country. There's tourism, okay? We also potentially could have very cheap labor. We could have manufacturing. Look at how great the export auto sector is doing. I think government should offer more incentives for countries to come here. But I made a comment, I think before the call started when we were talking, that we need a weaker rand in this country. And it's disgusting to most of us because we think, geez, weaker rand, that's inflation. Holidays are more expensive. The cars we want to buy are going to be more expensive. If we want to send our child to an overseas university, that's going to be completely unplayable. But a weaker rand solves so many problems. There have been a number of countries that have gone through this in the past. I think Poland is one of the most recent. And the solution ultimately is you get that much weaker currency. The currency is the escape valve. The currency will generate some inflation. It will help you with your debt to GDP problem to some extent, but it also creates the margin of safety that a lot of external investors require. So if you've got uncertainty in a country, what does that mean? You won't invest until you get a greater margin of safety. How do you get a greater margin of safety? Have a much weaker currency, and you go, oh, well, that doesn't cost me as much capital. So if an investor wants to do something in this country and it's going to cost them $100 million, the currency blows out and now it only costs them $50 million, and they think, okay, I'll do it for $50 million. So,
all right. I'm going to shift you onto where you're finding opportunities a little more specifically now, from an investment perspective. And this chart here shows you, if we talk SA equities, you mentioned finding, you want to be invested in stocks that can weather the storm or structurally benefit. For me, it looks like this market, if you look at the green line, it looks cheap. So our equity market has come off. We've seen a little bit of a rally, but it looks relatively cheap here. Should we be buying the market here? And can you give us one or two of the stock ideas that you're excited about?
Okay, so we look at this graph and we think the market's expensive when you look at this graph. So it's very easy to look at the green line and go, okay, so this is a PE back in 2005. The PE is kind of like at the levels it's at today. We thought the market was cheap in 2005, so the market's cheap now. Right? And you can see when the market peaked in 2014 on a PE basis, everyone was going, no, the market's not so great now. So obviously,
and the dotted line in the middle is the average, right? So it looks
exactly. So it's below the average, right? And so you could see why it was expensive in 2014, but there were still people buying. So if you're willing to buy in 2014, you should be willing to buy today. But the problem that no one thinks about appropriately is the orange line. And the orange line is growth in South Africa, GDP growth. And in 2005, GDP growth was, let's call that high 5 real, 5.5% real. In 2014, GDP growth was, let's call it, sort of end of 2004, between that 2014 and 2015 point on your graph, when the market was at its peak, let's say GDP growth was about 2.2 to 2.5%. And then last time we reported, GDP growth is 0. And GDP growth, we all agree, I think, on this call, I'd love to hear from someone who thinks it's not the case, GDP growth is going to be negative. So if we're willing to pay the same prices for 5% real growth versus 0% real growth or negative real growth, I'm kind of going, but then the value isn't there. The price may be the same, but the value isn't. So you're actually buying a business or a market that's more expensive. So by all means, we would say, do not buy the market as a whole. You can't do that. That's a losing strategy. So what do I buy? So you buy select opportunities, but okay, so let's talk about the opportunities quickly, right? The opportunity is, I'm sorry for the South African bulls out there, the opportunity is global equities. You go to global equities first. It's unfortunate in your pension funds, you can only have 30% offshore. In your personal capacity, you can have more than that. Global equities offer the best opportunity for growth, because you don't have to buy businesses that are highly economically sensitive. You don't have to buy banks. You don't have to buy resources. You don't have to buy insurance companies. You can buy the toothpaste producers. The old joke I used to make was, how bad do things have to get before you stop brushing your teeth? Well, things are bad now. Things are really bad. No one on this call has stopped brushing their teeth. In fact, I haven't spoken to anyone who stopped brushing their teeth. So if you buy Colgate, if you buy Johnson & Johnson, it's not going to be a problem. Right? So we go offshore first because the growth is there. Offshore, outside of South Africa, right? Because South Africa only has NASPAS, unfortunately, but offshore also gives you access to tech. Tech gives you access to online. And clearly what this means for everyone, so even the tech Luddites amongst us are looking far more tech savvy post the COVID crisis than they were pre. So there are going to be a lot more people online. People are going to be far more comfortable with online shopping now. People are going to realize, well, actually, I don't physically have to go to the shops. It's just, if you don't want to browse or you don't want the shopping experience, you're just looking for a book, just go to Takealot, go to Amazon, whatever the case may be. So we get excited about that. But then what we get most excited about, because, we've been banging our fist on the table about the FANGs for so long that it's really difficult to get behind them because of their valuations and because they're disruptive businesses. And even though they're entrenched, there are risks to these businesses, regulatory risks, politicians getting involved, and obviously given their margins, there are other businesses that want to disrupt them themselves. But we get very excited about the businesses that benefit from the overall trend, who are required that kind of support structure for those front-end businesses. So when you think about businesses like the domain name administrators like VeriSign, they administer the .com domain name, then it's not a crazy sexy business, but it's a fantastic business. You think about not the chip makers like Samsung, but you think about the people who manufacture the technology that the chip makers require, which is far less economically sensitive. And we get very excited about that. And that's where we look for growth. But then you come back to South Africa, again, it's not all slit your wrists. There's a great opportunity in South Africa right now.
But what do you own in South Africa?
Bonds. You buy government bonds. No, seriously. It may not
let's
sound...
get on to government bonds if you're not going to give me an equity name.
No. Hold on. Sorry. I don't want to mislead you. Okay, of course we own equities, right? So we're a little bit naughty because I'm calling them South African equities, but we like things like British American Tobacco. We like things like Mondi, but those aren't South African equities, right? But when you look in the South African equity space, you've got to be a little more careful. Shorter term growth is going to be impaired, but we still like the likes of Standard Bank. We still like First Rand. We've been adding to our position in the JSE. We think that's a fantastic business, highly cash flow generative. So there are businesses, but the opportunity set in South Africa is much smaller. It's better today than it was in 2014, and we've been adding to the portfolio. We love businesses like Clicks. Clicks is just so expensive, but it's probably the highest quality business in South Africa right now. So, at the margin, adding to portfolios, but, we're not as excited as we are about the opportunities offshore.
Okay, so you mentioned bonds. Let's move on. So definitely global equities over local equities. And when I know you mentioned SA bonds, and I stole this slide from one of your packs, and I can understand that bonds. What the slide is showing is essentially the yield above cash that you get. So it's a 10-year government bond minus the yield on cash, and it looks really high. So I can understand that. We've had the downgrade now. We are junk status. And actually, since then, our bonds have done really nicely. But you've just mentioned about this massive stimulus package. How are we going to finance ourselves? Yes, I take it you don't think we're going to be the next Argentina. But doesn't this have an impact on our bond market? Isn't it a risk for your holding in bonds?
Yes. 100%. There is a risk because the return is saying there's risk. If there was zero risk, the return you would be getting out of any investment would be the same as cash. But what is very strange is to suggest that you will only invest in bonds when there is no risk, but you are happy to invest in equities when there's a ton of risk. What we're saying is you have to have risk. You have to. What matters is how you manage risk and how you balance risk in portfolios. It's inappropriate for every position in your portfolio to take on exactly the same risk. You want to assume different risks. So when that risk hits, if that risk hits, you don't blow up a portfolio. So you want the diversification is point number one. Point number two, you also want to ensure that you're being appropriately compensated for that risk. So when we look at the markets and we say, it's not clear to us that you should be buying South African equities right now because growth is so low today versus 2005. Another way of saying it is, we are not convinced that you are being appropriately paid to take on the risks that you are taking on by buying equities. But when you look at South African bonds, you are being paid to take on those risks. And interestingly, COVID is a little bit, and this is a terrible thing to say, COVID is a little bit of a blessing for our bond market right now because bond yields are elevated. Everyone can see that, right? You can buy bonds, long bonds, at 9%. Inflation is low and falling. Inflation could be sub 3% at the end of this year. Could be like 2.9%. and which means that the real yield on bonds is very high. But those concerns that everyone has, look at the debt to GDP, look at the increasing debt to GDP. You come back to the point where I said, well, that stimulus package of 500 billion rands isn't that big. Well, it's not by global standards. There are other territories that are stimulating by far more. You know, what did Germany announce this morning? Was it 170 billion euros? Please don't quote me. I can't remember the exact number.
A lot more than us.
Was it a lot more than that? Okay, but
no,
yeah,
a lot more than us, I said.
Oh yeah, but I think my number's wrong, and there'll be other things, right? So it's much bigger than what we're doing, and they're a far better placed economy to deal with this crisis. And what that means is because other economies are spending so much more, their fiscal deficits this year are going to be larger, and their debt to GDPs are going to blow out. Now, we were never the outlier, but as a result of COVID, we're going to be firmly in the middle of the pack. And when everything is going wrong at the same time, what people are going to look at is going to say, well, South Africa is actually not doing too badly. We appreciate the fiscal problems. We appreciate what's actually happening with growth. But look at how attractive these bond deals are. And we're not saying you buy bonds and you hold them for 100 years. But right now, today, those yields are very attractive. And the situation could change. Either bond yields could come down and we don't get as excited, or equity markets fall and then we can't be as excited about bonds relative to equities. But let me put it this way, right? This sounds very extreme. If you are unwilling to buy a South African bond and the South African government holds the Reserve Bank holds the Rand printing press, you cannot buy a single equity that is in South Africa. SA only equty. Not talking about BTIs, not talking about Mondi. You can't buy a bank. You can't buy a retailer. You can't buy an industrial company. You can't even run a business in this country if you're unwilling to buy a South African bond. Close your business, leave now, if you're not willing to buy a South African bond.
So positive on SA bonds, sure. I'm glad that I found something positive. Okay, now we're going to talk just cash. Okay. This year alone, we've seen cash rates almost halve. From 6.5 at the beginning of the year, now at 3.75. As we heard from Kabir Naidu on Tuesday, you know, it's the SARB's way of trying to assist the market. And what you're seeing on the slide now, everybody, is the repo rate and inflation. What are your guys' expectations of where interest rates will go to, and will these cuts actually stimulate growth?
No, we don't think these cuts are going to stimulate growth. So there's a problem, right? The cuts aren't stimulating. So the cuts will prevent SA being strangled the way it was. So that's a great graph, Siobhan. I really like this graph. So your purple line are interest rates, your green line is CPI, right? When the government needs to stimulate the economy, they run a policy of negative real so that the purple line is below the green line, but they also take into account the impact on inflation. They take a look at GDP growth. We think that's on government and the SARB. We think the SARB's behind the curve, right? And the SARB's been behind the curve since 2015. So if you look at your graph, between 2011 and 2014, the SARB ran negative real interest rate policy, right? Interest rates bottomed, inflation kind of bottomed, then picked up again, and the SARB was looking through that and they raised interest rates. But look at what's happened to inflation since 2015. It's been on a downward trend, okay? And not unsurprisingly, that corresponds to what I've been saying about GDP growth per capita has been negative since 2015. The consumer's been in trouble. Retail sales haven't been great. This country, you know, the economic growth has just been going down. And you see the same thing, even if you look at overall GDP growth, you know, it's just not negative, but it's been on a declining trend since 2005. So the SARB's interest rate policy between 2015 and 2019 was actually becoming more onerous for our country. And as far as we can tell, the SARB was basically defending the Rand. They felt that they didn't want the Rand to blow up because the Rand would drive inflation. But the pass-through to inflation from a weakening Rand hasn't been of the same magnitude that the SARB was expecting. And as a result, I think the economy, this was part of the reason that the economy got weaker. Now, you look at where we are now, and we're sitting at interest rates of 3.75, but we could see inflation of 2.9 or 3 this year, which means you're still running positive real And so we believe that the SARB needs to get to a point of negative real interest rates in order for those rates to be stimulating to the economy. But I don't think they're keen to do it, because if you look at the last MPC meeting, 2 members were already saying, oh no, only a 25 basis point cut. The majority, thankfully, were at 50 basis points. But it suggests that they're already moving into an area where they're not clear that the economy needs more interest rate cuts, because they think, oh no, but the recovery will come. Maybe GDP is not going to be as bad. Inflation isn't going to be low as people expect. I mean, look at this recovery that the graph shows in inflation. I mean, this is consistent with market expectations, where you're saying that this goes up to 4.4% by the middle of next year. Yeah, and that's well possible. You know, there'll be base effects, obviously. But if you don't have a strong consumer,
cash rates will stay here, or potentially there's a small chance of them going lower, making cash quite an unattractive asset for you.
Correct. And we want cash rates to go lower. We would like the central case to be that they go lower, but you know, we think that the SARB is going to be behind the curve. But even if they don't go lower from here, you know, cash used to be a great investment. You know, for the last couple of years, it's given you an average of 7%, but that's not going to be the case over the next 5 years. And as a result of that, you need to move away from cash. And given the uncertainty around local equities, it's another reason that South African bonds become so attractive. Because you think about cash at 3.75, you think about those bonds at 9. That's a very big gap.
Big gap. Okay, I'm conscious of time, so the next few questions I want to leave a bit of time for Steve and Menachem to consolidate some other questions to you. But just quickly, I want to ask you your opinion on property and then on offshore. For years, property was a fantastic asset class. I mean, loved. It generated significant returns to investors. We went into the crisis with a very weak backdrop for growth for South Africa, which obviously wasn't good for the property sector. And I mean, year to date, the last time I checked, I think, which was last week, the property sector was down 45%. Given that it's been so hard hit, and I'm conscious, I hope there's no relation. I saw a CEF on the call. Are there any juicy investment opportunities that are out there in this space?
We're not sure yet, so we're doing work around it. Our assumption is there should be a juicy investment opportunity, right? So if you look at, historic distribution yields on average are sitting at 17% now. You know, so those distribution yields went all the way down to, I think, 4%? And now they're sitting at 17%. Now, obviously, we don't expect those distributions to stay where they are, because you're well aware that rentals are going to be cut. There are a lot of businesses that are on their knees. But prior going into this crisis, what everyone was worried about in property, because people were turning very bearish on property, and we were bearish on property for years. We were bearish for property for, I think, since like 2007, and we were wrong. You know, it's only in the last 3 years we've been proven right. So everyone, please take what I'm saying with a truckload of salt, because we were being laughed at in terms of our property view prior to this. So maybe you're going to laugh at me going forward. But, you know, maybe there's an opportunity coming. But remember, prior to this crisis, what everyone was worried about was the overbuilding of malls throughout South Africa. You know, that rental reversions actually had to be negative in the retail space, and you were starting to see that in 2019. And then they were also worried about the overbuilding of office space in Sandton, and to some extent in the Cape Town CBD. And you see it on the Umhlanga Ridge in Natal as well. But, you know, you had these giant corporates that moved into new head offices and left a lot of office space vacant. And so we think, so office vacancies were already high going into this. And now you're in an environment where a lot of businesses are probably going to realize that you don't need your entire staff complement in the office at the same time. Because I think there's going to be an acceleration of this work from home concept. And you think about businesses in London, a lot of people work from home 1 or 2 days a week. And I think that's going to become a more global phenomenon. So you're going to need smaller office space, number one. Number two, the very sad part of the COVID crisis is I think a lot of small businesses are going to go out of business, the SMEs, where there's the potential for real unemployment to arise. I don't think the problem is going to be with the giant corporates. The problem is going to be for the SMEs. And SMEs that go bankrupt are not going to need that office space. So we're going to have a little bit of an office space crisis. I think there's going to be too much of it. So what we're trying to do is we're trying to sharpen our pencil on what does that mean in terms of margins of safety. What you do know is net asset values, the valuations of these businesses have to come down. The price is already telling you that, because most property companies are trading at a 50% price to book or lower. rental growth is going to be lower going forward. So, you know, previously people would pencil in 7 to 10% rental growth. I think you're going to be penciling in somewhere between 3 and 5% rental growth going forward. You are probably going to have to start worrying about the structure excuse me, of these buildings. I don't mean the integrity, but you think about shopping centers, the amount of maintenance capex that was spent in the past. I don't know if property companies are going to be able to spend that in the very, very short term. And then ultimately, you also need to be very worried about distributions. So people get excited about REITs. REITs have to pay, I think it's, well, they have been paying 90% of their earnings. And I think the regulated minimum to be a REIT, I think is 75 or 80%. I'm not entirely sure. But they pay more than the regulated minimum. And obviously the JSE is engaging with investors and related parties to ask if there can be a standstill of that payment for 2 years. So property companies, much like other equities on the exchange, are probably not going to pay a distribution. And that brings me back to the bonds, which are going to give you a coupon of 9%. Sorry, I thought I'd just slip that in there very quickly. So be careful. But we certainly think they potentially offer very exciting value, but we've got to do our work and make sure about that. Oh, sorry, because the last point about property companies, sorry, 2 last points. I'm so sorry, Siobhan. They do have a lot of debt, and those loan to values, which are currently sitting at about 40%. If the net asset value, if the valuations of their properties halve, that loan to value is going to go to 80%. But the one silver lining for property companies is we don't think they're going to go bankrupt, because who owns the debt? The banks own the debt. Do you think the banks want to own these properties right now? Of course not. Because you take on these property books, whenever you possess an asset that people, you know, can't make repayments on, you look to flip it. Who's going to buy a giant building from you right now, put 100, 200, 300 million into a building? So we think that the banks will actually give property businesses a little bit of a standstill on their repayments. We can't see them going broke. You know, it's that old joke. If you owe the bank R1 million, it's your problem. If you owe the bank R1 billion, it's the bank's problem. So I don't want to be too flippant. Sorry.
All right, let's just shift on. You have touched on a little bit of the longer term implications of COVID-19 already, but I just want to show everybody this chart, which I think is very interesting.
The TomTom data.
Yeah, it's TomTom data, and it shows the traffic congestion in Wuhan. And what you can see is that post the lockdown, the congestion during the week has gone back up to what it kind of was last year. But what people are doing on weekends, and that's where the little green block is circled or whatever, is that during weekends, people are choosing to self-isolate. And I think this just proves one of the structural changes. People are obviously still nervous. You're not going to go back to your normal habits, you know, straight away. And I think that's what Sumesh, your guys' team, is thinking about. What changes, you know, post lockdowns, and in a year or two's time, when it comes to from an investment perspective. You've spoken about, you know, people order more from an online perspective. Any other sort of industries that might have changed forever?
Yeah, no, spot on, right? So this really speaks to how you've got to be very careful about discretionary consumption, because, I mean, you know, your weekends are all about discretionary consumption, and your traffic being back to 2019 levels during the week at peak traffic hours really speaks to the fact that people need to earn cash. You know, they're going back to their jobs. So I think what this does is it accelerates a number of the trends we were already seeing. So businesses that you thought would be let's say at a more sustainable level of profitability 10, 20 years from now, I think you'll see an acceleration of that. That's going to happen a lot faster. I think, you know, businesses like Amazon do get stronger. I mean, businesses like Netflix get even stronger still, because, you know, you think about the number of new Netflix accounts that are opening up. But in all of this, you know, I think it's very easy, and this is the risk to investors, that you end up getting more excited about those businesses whose prospects have improved or accelerated, but that aren't generating the required cash or the appropriate return on the capital they have available to them. So we're still very much focused on that. Be careful about getting caught up in the chaos, for lack of a better word. So you've got to stick to the fundamentals. You've got to ensure that the valuations are appropriate, because you've seen the bifurcation of the market. You've seen how those tech businesses have continued to run hard. leaving a lot of other businesses behind. There are a lot of businesses where people have assumed resilience, and they are paying significantly higher prices today than they were paying just pre-crisis. And I think it's too soon to draw that conclusion if those businesses aren't generating cash. So I guess what I'm saying ultimately is there are a lot of boring businesses you still want to include in your company, in your portfolio. And when you build your portfolio around exciting businesses, make sure those exciting businesses have cash. And I come back to the businesses that we're already excited about. We were excited about pre-crisis, and we're more excited about today. Businesses like Visa, VeriSign, and ASML.
Yeah, I'm going to skip through the slides. Menachem can send this out to you guys. I stole it from your packet. I do, I mean, you've spoken to some of the more exciting things that are beyond my everyday, but I think what this shows you is how integrated some of the companies are in our everyday life. And these potentially are the slightly more boring ones. And we were on a call earlier this morning, and someone said, sorry, excuse I'm just making an espresso in the background. You know, it is part of our everyday life, a lot of these companies.
Yeah, I mean, look at how well Naspers has held up through this crisis. And it's all been about Tencent, and it's that 6 p.m. element there. FIFA, electronic arts. We hold electronic arts in the portfolio. But Tencent's been a massive beneficiary of people staying home and playing games.
Not me. Anyway, we spoke about this a little bit before the call officially started as such. But so we won't go into maybe the nuts and bolts of the rand. I think, you know, on most metrics, you could consider maybe that the rand is cheap. On most other people's metrics, I think you stated that it should be cheaper. But it's reflecting a poor fiscal environment and this risk-off environment that we've seen. If I gave you R1 million today, where would you take it offshore or not? I mean, is there a possibility the rand strengthens in 6 months' time?
What's my time? Oh, yes, sorry. Yes, there is a possibility. There's a possibility the rand strengthens in a month. But what's my time horizon for taking it offshore?
5 years.
5 years, then yeah. And I guess, look, you got to be careful. It depends on how old I am, how much I've already saved, how the savings already split. But if I suddenly received R1 million today, I wouldn't take the million offshore right this very second. What I would do, given that the rand is cheap, is I would start taking it offshore with a view of that 5 years. So I'd probably do 200,000 rand immediately. I'd probably try and do another 200,000 in a month, and you know, so over the course of the next 5 months, you're taking it out, right? And look, I don't like your example. I'm sorry, because it's a little bit artificial. Let me tell you what I'm doing. Okay, so you know, in the portfolios we're positioned, that's absolutely fine. Maybe you get new cash flow, maybe you don't. But in my personal capacity, obviously you earn a salary, and I'm saving all the time. And what I'm doing is on a systematic basis, either monthly, I'm putting it into feeder funds, or when I've got a lump sum together, every year, irrespective of where the rand has been, I've taken half my savings offshore. Because, you know, the problem, I'm sorry, I sound like a broken record for those of you who've heard it before. The problem that we face as South African investors is we are too comfortable putting the majority of our capital into a country that represents less than 1% of world market capitalizations. That's not diversification. And then even worse, a lot of people go, okay, you're right, let's diversify. Oh, I can get excited about India or China or Brazil or Russia. Those are EMs. EMs are highly correlated. You know, we were talking about the rand up front. The rand moves with other EM currencies. That doesn't really give you the diversification you need. So the diversification means developed markets and industries that we can't be exposed to here. So I think it's really important to appropriately structure your portfolio. The other thing is, remember, there's an inflation differential between South Africa and developed markets. So the rand has to depreciate over time. The question is, how fast does that depreciation happen? A lot of it has happened now with the crisis. Maybe it pulls back. You know, a lot of people make the mistake when the rand is at its weakest, they take a ton of money offshore. It happened in 2008. It happened in 2001. A lot of big South African businesses, I can finally say it now that we're 91, Investec and Old Mutual made huge mistakes. Why? Careful.
They're still an investor in us.
Yeah, they're an investor now, but they can't fire me. Well, maybe. But the point is, they made huge mistakes, and they took capital out to invest offshore when the rand was at its weakest. So you've got to be careful about that. That systematic movement, if you have an appropriate way of thinking about it, you're thinking about diversification, you're not thinking about this gut reaction to what the rand is doing. It's far better. And it's, of course, painful. Like a friend of mine spoke to me, I don't know, maybe 6 months ago, and we were talking about the strategy, and I've been, this continually taking money out, and I'd been taking it into pounds, just the way the bank accounts worked. And he asked me what my average exchange rate had been. And it was 16.6 at the time. And it was painful. And I hated it. And I was like, look, you know what? Close my eyes. 20 years, we'll talk again. It will be the right decision to make. And I look at it today with a pound of 21 to the rand. And I think, wow, that's
good job.
It leads to that systematic removal. Yeah.
Okay. Seeing as though you got that right, I want to talk about, look, the last few years have been tough for investors in terms of absolute returns locally, specifically. And the last little while has been quite scary with the massive down and then a little bit of an up as well. So very volatile. These are your expected returns going forward. And without crystal ball gazing and things like that, from a balanced fund, kind of what can you expect, sort of tell investors to expect over the next 5 years?
You mean in an overall return sense?
Yeah.
So,
yeah.
As long as you have appropriate balance in your portfolio, we think you will generate real returns. It depends on how you combine those opportunities, but I think you could do inflation plus 2, 3, 4, 5. It's achievable with the appropriate returns. But what you've got to focus on is that balance. And what we like about thinking about returns in this way and presenting them in this way is, number one, it gives you a sense of the potential range of outcomes, right? So you look at global equities, maybe you get 10% in rands, maybe you get 15% in rands. And the midpoint of those numbers is kind of like, where we think a realistic number for the overall return is, but it gives you this corridor of uncertainty. But coupled with that expected return, look at the size of the corridor. And the larger the corridor, the less convicted or the less conviction we have. And so you would expect to see the higher the average and the tighter the corridor, the more there would be in the portfolio. And that's why we get so excited about global equities and SA bonds. Now, just to be clear, remember, even though the corridor on cash is always very narrow, cash doesn't move around a lot. You kind of know what the return is. So what really matters there is the overall level. So just be careful of that. Just because the corridor is narrow doesn't mean you should be holding a lot of cash. You only hold a lot of cash when the corridor is narrow and the return is high. So investors really should focus on global equity and SA bonds. But what's great about very wide corridors is the wide corridors suggest that's where you should be looking for opportunities. That's where you should be doing the most work. So I think you can comfortably allocate to global equities and comfortably allocate to global bonds. But where you should be focusing SA bonds, apologies, global equities and SA bonds, right? You put the money in there, you're thinking longer term, you wait for to achieve the levels you're looking for. Where you should be focusing a lot of your time and energy looking for opportunities is SA equity and SA property. And that's what we're doing. Because there could be diamonds in there. Maybe there are, maybe there aren't, but we want to find risk-adjusted return diamonds.
Okay. I'm going to stop sharing my screen now, and I'm going to hand back over to Menachem and Steve, who I think are going to, thank you, Sumesh, are going to give you some more questions to answer, hopefully.
Okay.
Guys, I could honestly listen all day. And if you take a look at the comments that I've been receiving on my WhatsApp, I think everybody feels the same way. It's been fantastic. And actually, quite genuinely, it's a genuine privilege to listen to the two of you. It's absolutely insightful. And ladies and gentlemen, when we spoke initially about the type of asset managers and specifically Octagon's move into quality asset managers, you've now heard an unscripted talk about exactly why we're backing quality managers in these difficult times. Because if anybody's going to help us navigate our way through this, it's the quality managers. And for those of you thinking that we gave Sumesh a script and asked him to keep to it, because we've been drumming home this exact message over the last 5 or 6 months, and now Sumesh has just in his beautiful way, put it across exactly how we would have put it across. So thank you so much for that, Sumesh. And of course, thank you for making us look smart. It's really appreciated. But at the same stage, one of the Octagon way of investing is we will use Sumesh's fund, we will use other people's funds, then we'll blend them together. It's called a fund-of-fund approach. And in this fund-of-fund approach, we're Siobhan, stay online because some of the questions are going to you. So stay where you are there, sec. But we're going to be asking a whole bunch of questions over here that a number of people have sent through. I think Siobhan thought she got a bathroom break. Not yet, Siobhan. So I actually don't know where to start. So what I've tried to do over here, as I said before, is collate the questions into. Okay, so if you could just watch your mute sounds there, guys. Just makes life a bit easier. I've tried to collate them into different areas. If some of the questions are repeat of something that you said, if you could just bear with us, because obviously the questions came through over the last hour. But let me start with some controversial stuff. George and Neil were talking quite heavily about China. Is it not time for us to have greater China's exposure, especially their currency? Now, obviously, China is a provocative topic. A lot of people are, let's not buy China anymore. And it's not just buy South Africa. It's more like buy anything but China. But from an economic standpoint, where we have the luxury of not being bogged down by our own concerns about whether China did start the virus or didn't start the virus, separate issue. So the question is, how can we get more exposure? And further to this, the question was, in that China will be larger than the US as an economy. Just they were at one time a tiny economy. They've grown. They on track. I think it's within 4 years, if I'm not mistaken, to be a bigger economy than the US. And as that goes, how do we take advantage of this? Do we take advantage of this? And as asset managers, we do have a moral responsibility, but our other responsibility is to ensure that we're making money. So how do you feel about this one, Sumesh?
I 100% agree. You should have exposure to China because, well, remember, China was bigger than the US centuries ago. China is going to be bigger than the US, and that's the concern the US has, that China is going to be a bigger superpower than the US will be. But now you take the politics out of it, you take, like who you think is naughty and who you think is nice out of it. And at the end of the day, right, China is an infrastructure-led economy. So all the growth, or majority of the growth, comes from that infrastructure. Only, I think, 20-30% of GDP growth comes from consumption. US is 60 to 70% consumption led. SA, believe it or not, is also 60 to 70% consumption led. China acknowledges that in order to be a more stable economy, they need to move to being consumption led. And you saw this occur with South Korea. I think it was in the late 60s or early 70s. They were infrastructure led. In fact, those of you who haven't done it, visit South Korea as soon as we can get on a plane and we've got the vaccination and all the appropriate caveats. Those of you who haven't done it, please visit South Korea. For years, I heard that South Korea is the model for China. And then I visited South Korea about 5 years ago. And it's 100% right. China wants to achieve what South Korea has done. And South Korea was an infrastructure-led economy in the 60s and 70s. And then they switched to consumption-led. But the problem is when you switch from infrastructure to consumption, you could be growing GDP by 10% real, and that collapses to 2 or 3% real. Because consumption is not going to get you 10% real growth, or consumption alone is not going to get you 10% real growth. That's the direction China's heading in. But what's fantastic about China is you've got this 1.5 billion consumer population, and you have this rising middle class that we'd hope to see in South Africa, but that just hasn't come to fruition. So there are these consumer-driven tailwinds that are going to occur. Now, how do you invest? This is where we struggle. Because obviously we have people on the ground. We've got business-speaking Mandarin investment professionals in our team, in our quality team. And fantastic, you can put your capital there. But when you think about the Opportunity Fund, when you think about the Cautious Managed Fund, we've got to think about capital preservation. So while it may be a little bit uncomfortable for us to buy high multiple, very fast-growing businesses where we might be a little bit concerned with the accounts and the regulations surrounding those businesses in China, where we get a lot of comfort are with US-listed developed market businesses. They're not going to be US businesses, but let's say listed on appropriate exchanges where the regulations are appropriate, where we have a lot of access to management, and where management teams have their people on the ground and they are selling well-established products to the Chinese consumer. The Chinese consumer wants those Western products. They want those global brands. You think about LVMH, you think about Richemont and its watches and its jewelry, you think about businesses like Hermes, those consumer-focused top-end businesses. And then you still think about like, the Johnson & Johnsons of the world and the focus that Chinese consumers have on baby care, for example. And China is becoming an increasingly large component of those businesses. So now while you may not get the runaway growth you will get from investing in a physical company in China, we do get a little bit concerned about how close we can get to that business versus some of the businesses that we can access elsewhere. If you are willing to take on more volatility, more risk, and not worry in achievement of higher expected returns, and you don't worry about shorter-term capital preservation, then by all means, invest directly in China. Buy the highest quality businesses that you can find in China. And then when we think about those businesses, we think about businesses like Alibaba, we think about businesses like Tencent, and we can get very those businesses.
Thank you. I'm actually just trying to decide which ones to ask you here. Here's a question on bonds. We spoke about bonds. Obviously, it's a very big play these days. So a question asked over here, and I'm going to just quote it directly. It's from Moshe. It says, who says the government will honor the SA bond repayments on maturity? Interest, yes, they will pay. But in 5 years, who says they will pay capital? Reworded, who says they will have capital to pay? That's number one. And number two, he comments that there's a record withdrawal in SA bonds investments at the moment. But one of my concerns is when I was a youngster studying, a lot of my friends went off to do work in Caracas, that's Venezuela. And they came back and told us about this utopia called Venezuela. And I also thought that one day when I'm traveling, I'm going to go to Venezuela. And today we're talking about the failed socialist state of Venezuela. And we all know what happened when we had all those defaults. So how do you hold about that? And that it's a difficult question because I am going to ask you more questions about the South African government, about the future for the people on this panel. And I don't have to spell out who's on this panel, not on this panel, who's on as our audience, myself inclusive. Difficult questions.
Great question. I love that question. So what a lot of people forget about the SA structure is or the SA bond market is we're a lot closer to a closed economy bond market like China than we were to more open economy bond markets like Venezuela, Argentina, Brazil. Okay, so you brought up Venezuela, but you can bring up Argentina and Brazil. I guess Brazil doesn't.
I've got cousins in Argentina. I like the place. Forget about it.
Okay. I see. Fine.
Good meat. Great meat.
The food's great. Food and the wine are great. So what people forget is that a very, very small component of our bond market is dollar denominated. And what I mean by that is how much have we borrowed in dollars? And of the government borrowing, only 10% is borrowed in dollars. So the biggest concern for these economies is that there's a massive debt spiral when the rand blows out or their local currency blows out, the peso blows out, for example. But when the rand blows out, it impacts 10% of our debt. 90% of our debt is denominated in rand. So yes, everyone looks at this and goes, geez, foreigners were 40% of our debt market or our bond market. It's down to 33% now, last reported number. And just so you know, that 33% holding by foreigners is the same low level we were at when we were at Nenegate. After Nenegate's holdings increased and now they've decreased. But remember, risk off means money leaves emerging markets. It's not necessarily just a South African phenomenon. But now, if only 10% is offshore, it's only 10% we need to worry about. The 90% that's here, even though it's held 33% by foreigners, you pay back in rands. So you know how the government pays you back if they don't have money? They turn on the printing press. And they go, we don't care what the value of the rand is. Here it is. Your rand today is, it's 18 rand to the dollar. I will give you back every cent I've borrowed for you. Sorry, Mr. Investor, it might be worth 100 rands to the dollar, but you got all your money back. I didn't default. And when you have money in South Africa, what you care about is that return of that capital. Because a lot of investors are saying, hold on, don't buy SA bonds. And it's kind of, where do you go? They say, okay, no, hold cash because you don't want to take any more money out. So I'm only talking about the money you still have in South Africa. But if you hold in cash, that exchange rate is exactly the same problem. So you could have been in a situation, let's say the government defaults in 10 years, and let's say interest rates don't change, bond yields don't change, it's only the rand that's moving. So for 10 years, you could have made 9% per annum, and then you're sitting with materially weaker rand, or you could have made 3.75% per annum. and then you're sitting with a materially weaker rand. So Menachem, that's kind of how we're thinking about it. Now, it is a bit flippant to say they own the printing press, okay? There is an element here to say, look, there are going to be structural reforms of some sort. Things should get better. We're not saying they will get better, but we're saying there is an element of a bull case there. But when we think about including bonds in the portfolio, we forecast rising debt to GDP, weaker growth in this country, and that yields go up from here. And so even though yields go up from here and you make some capital losses, the coupon is so high that you're still making a return of about 8%. And you compare that 8% return with a volatility of about 7% to a 3.75% return out of cash with a volatility of 0.5%, you're going, okay, the 8% return makes a lot more sense. And then when you compare that against local SA equities, if you were to buy the index today, just the index, not the best stocks, but just the index, we think you could probably achieve 9 or 10% over the next 10 years, but that's with a volatility of 22. So you'll get 2% more out of the equity market over 10 years with 3 times the volatility. Maybe 4 times the volatility. That's how we do the comparison. And so I was being somewhat flippant when I said, look, the government will turn on the printing press. Inflation is then what's going to kick in, unfortunately.
Okay, I'm going to get back to some pointed questions about South Africa that I think we're all afraid of, but let me work my way there because I'm actually nervous to even ask the question itself. So let's discuss the rand. So the first question, and there are 2 questions, I'm going to put them together, was, and we spoke about the liquidity in the rand being the most liquid of all the emerging market currencies, which is why we are always the worst performing or the best performing. And you typically see these sensationalist headlines. And of course, we all capitalize or lose on them. And you spoke about mistakes that certain corporates have made. We still have a very close relationship with your former partner, so we have to be careful. So, but I worked at another corporate in a former life, in my treasury life, and I saw them making the same mistake. And in 2001, it was catastrophic. I mean, it wiped out their returns for 4 years. But let me just talk about this. On Tuesday, many of us were fortunate to have Kubir Naidu, Deputy Governor of the Reserve Bank. And he spoke about the phenomenon that as we've removed exchange controls to the level they are, I mean, we all remember what they were when we were youngsters and now what they are now. The question really is that what do you feel about the regulation that prescribes that certain assets, for example, a person puts money to retirement annuity, for example, ladies and gentlemen, you can't take more than 30% of that money overseas. It's different with a living annuity, but as an example, retirement annuities, you can't take more than 30% offshore. If you were to be speaking to our Reserve Bank and to the government, and they would ask your opinion, do you think that they should remove those controls entirely? Because as Kubir Naidu said, removing those controls actually incentivizes us as investors to be more thoughtful. We're not as fearful. We've got to get our money out because tomorrow, who knows? And I get very, very often, and I say I mean the advisors at Octagon, we very often get asked their question. When Julius Malema becomes the new Prime Minister, President, and we all say, God forbid, in unison. But when that happens and he undoes all the exchange control, George Menezes is shaking his head terribly there. But when that happens and he undoes the relaxation of exchange controls, I don't have that particular fear. But my question to you is simple. Should we remove these prudential guidelines, which limits us from investing at 30%? Or is this a wise thing? And of course, that's an advice game so much as an economic game. What do you think?
It's not an easy question because I understand where the guidelines come from, or I think I understand where the guidelines come from. And what you're doing is you're trying to protect the least sophisticated individual. So if you could assure, so I mean, Menachem, if you think about this, right, you think about your profession, you think about my profession, we all believe that there are some really poor operators in our field that shouldn't be doing what they're doing. But let's say the barriers to entry are just far lower than they should be. And I think the Prudential Authority is just providing an extra margin of safety. So when they say things like, you can't have more than 75% in equity, so forget this global local, they're just thinking, well, there's the risk someone who inappropriately manages a fund, even though we vetted them and we think they're appropriate, they go off the rails one day, they put 100% into equities, the market collapses, someone needs to retire. That's just too much. Now, the difference between 75 and 100 is not that big. you can't have too much control over this. You can't go down to 50 because then you'll prejudice people with longer term horizons. And so similarly, I think they've also been somewhat reluctant to add the rand volatility to portfolios because they can't ensure that portfolios will be appropriately balanced. So we always ensure that our portfolios don't take on a lot of rand risk, even though we want to use up to 30%. So bonds are a great offset because they're negatively correlated, but you can't get that throughout. Now, I would much prefer if that the requirements were a lot tighter, ensuring people who were managing funds were, even better qualified, let's say, or were more thoughtful about how they did things, and you had 100% flexibility, and every manager gave proper thought to who was ultimately the end client. So, I believe in an open economy. I believe in, completely free markets, that there should be self-regulation, but it doesn't work for all parties. That's the difficulty. So I do appreciate where they're coming from, but I still think it's too tight. I think there's somewhere in between complete freedom and the restrictions that they have here. Because remember, there were huge restrictions on hedge funds until a few years ago, and now there is an allowance for hedge funds under regulation 28, and there's still a lot of things you can't do. Something crazy like, we don't talk about Reg 28, medical aid was Reg 29, the medical aid fund restrictions. You're not allowed to use foreign aid. That 40% you've got. And then to your final point, I completely agree with you that if there were no exchange controls, people wouldn't be as stressed about taking money offshore. I think there would be far better capital flows. And we saw that when exchange controls were lifted, they got rid of the financial rand and the commercial rand. And money, global money actually came into the country. And I think people felt a lot more comfortable. So when they raised the limitations recently, what are we on now? 10 or 15 million rand a year that you can take out. There wasn't a massive rush to the doors. A lot of cynics, the SA bears, the rand bears said, that's because the people who want to take their money out have already taken it out, and the people left don't have money to take out. But I think it's what you say. People are more inclined to do something when they're not allowed to do it. And I think they'd be far more thoughtful when they're allowed to do anything.
Absolutely. I've got two more difficult questions, and I am a little bit nervous about how I pose them. And there have been a lot of questions, but we've been going for 1.5 hours, and I can't thank you and Siobhan enough. I could literally be all day, but I'm sure you've got other things to do, like manage our clients' money. So let me just zero in on two more questions, if you don't mind. And the one is actually, it's one of the questions that Siobhan ran out of time to ask, and I think it's such an important question. We debated this at our Tuesday staff meeting. It's a question of prescribed assets. Now, for those who've been living for more than the years of democracy in South Africa, will remember that our previous government handed democracy an absolutely insolvent government. And we speak, in privileged circles, there's this very often quoted scenario, which is an absolute garbage lie, that the previous government managed our economy so brilliantly and handed the ANC an absolutely solvent, brilliant operating business. Well, they didn't. There was infrastructure that was in really, really bad shape. There was an absolutely insolvent government. We were an economy that was so horribly insolvent that we were so blessed to have phenomenal managers that got us out of the mess. And then, of course, we've lost the way later on. We all know that. But the lie that we handed over a solvent government is just that, a lie. But one of the things I want to discuss with you is prescribed assets. And that is that I grew up I was born in 73, in the 70s, 80s. We all know that the previous government had prescribed assets, and it was a total disaster. Neil Jankelowitz, one of our advisors, quoted from, I think from Prudential, that 9%, 8 point something percent, rounding up to 9%, was what investors lost per annum on prescribed assets. These are horrific numbers. So in that, prescribed assets is not a unique thing to South Africa. It's not a unique thing to our democratic government. Firstly, do you think they're going to happen? How do we protect ourselves against them? And what's your opinion about them in general?
Okay. Can I comment on your first statement about the solvency of the government pre-opening up of the economy? I don't want to get into the debate about whether it was solvent or not solvent, but for those people For those people who do think it was solvent and it was a well-run financial system, please remember that the infrastructure and the finances were only being run for 15% of the population. So if you exclude the other 85%, you can go, wow, it was wonderful. But you've got to exclude the other 85% of the population. The moment you count the full population, you can't make the same statement. So that's really important to state. So those of you making that argument, be very careful what you're actually saying then about the population as a whole. And then when you think about prescribed assets, it does reflect on the first statement I made. What's ideal is you don't impose controls on anyone. You allow for thoughtful consideration, and then you get an appropriate allocation of capital. Because the irony is, if no one thought prescribed assets were going to come along, more people would probably buy government bonds. But a lot of people are sitting here thinking, wait a minute, I'm going to be forced to buy government bonds, so why buy them now? Let me put my capital to work wherever I can, and ultimately I'm going to be forced to buy government bonds, and then, we'll own them. So when we look at prescribed assets, I'm only probably saying this for like the 100th time today, but we're bond bulls in South Africa at current levels, right? Not bulls about what's happening in South Africa, but we think that bonds already price in a lot of that. So we look at prescribed assets. And if we said the government had to come in tomorrow and say, you will invest 10 to 20% of your pension fund into bonds, government bonds, we look at this and we say, but actually right now, that's a really good place to be. It makes a lot of sense for investors. It's much better than cash. It's much better than SA equities. So it's not a train smash. The second thing is, and now we're talking our own book, is we get excited because we're already holding government bonds. So if government came along and said 15 to 20% of the portfolio must be in government bonds, we go, fantastic. We're already there. Come join us. The water's warm. The yield's going to go down. We'll make a lot of money for our clients. So I've got to disclose that because, it's talking our own book. But ultimately, Menachem, your point is still valid. The idea of that artificial limitation isn't great. What worries us, though, what keeps us up at night is what happens if the prescribed assets don't take the form of government bonds? So, the government's already mooting an infrastructure fund, for example, saying, well, we need to create this infrastructure spend because capital expenditure from the government is non-existent. They don't have the money for it. Let's turn to the private sector. Let's turn to the investment funds that exist in South Africa. And if you were to do that, that would actually worry us. Because if you were to have a fund, for example, that was run by the government, we're not clear in our minds that government expenditure is 100% of government expenditure is going where it needs to go. Corruption hasn't been stamped out. There is so much inappropriate spend that's unaccounted for. You look at the audits of the different provinces and municipalities. There's money that people can't account for. So why do we want another state institution that controls money or has control over that cash? That would worry us. The bull point on that, though, is people are arguing if government were to enforce this concept of prescribed assets on anything other than government bonds, then there'd be a lot of debate over the definition of those assets. So if government said you have to put 10% of the fund into infrastructure, people would start arguing about what infrastructure meant. Does it mean you can invest in solar and wind projects? Can it only be roads? There's a lot of confusion around that, and government would obviously want the capital. And then the last point I want to say about prescribed assets is, remember, if you were forced to put 15 to 20% of pension funds into government bonds right now, which, as I said, offers great value, so I wouldn't be too concerned about is it an appropriate investment? Longer term, that's actually better for the country because what it does do is it drives down yields. And for those of you who are worried about a debt spiral, unaffordable costs, where's the demand for debt going to come from? It would be a potential solution. And I don't think it's a crazy solution because we wouldn't be the only country in the world that does this. And we have had it in the past. It's not ideal, but I think it is a potential solution to our problems. I would not be completely averse.
So let me wrap up with the following question. And it is a bit of a hospital pass, but I think it's quite necessary over here. So, again, we had this Tuesday meeting, all the brokers at Octagon, and it's really a summation of the questions that our clients are asking us during the week, and then we have them together. And Sumesh, you've addressed us over there, and your advice is invaluable on that. But when we look at this and we say the people on this panel have chosen to live to stay in South Africa. Sumesh, you have chosen to stay in South Africa.
Yes.
Whilst you don't have to. You could go live in England. working for 91 Asset Management in
Correct.
London.
Mhm.
Siobhan, you're the same. Everybody at Octagon is well educated. We are thankfully very much in a position to be liquid and to move overseas. But we are, for the moment, in my case, very much choosing to stay in South Africa. And so, but then again, every morning I hear about somebody else who's planning to leave.
Mhm.
And it's irritating. It's irritating that I'm saying, am I going to be the bloke turning off the lights? What they do is their choice. But am I going to be the bloke turning off the lights on a bankrupt company? My Caracas example that I spoke about a few moments ago. So, in your opinion, if you were to sit on a panel of potential immigrants, people who are potentially going to leave the country and where they're going isn't relevant, and they were youngsters, and you were saying, guys, we think that there's going to be opportunities in South Africa. There's a brilliant book, Bruce Whitfield just put out a book about amazing companies that were started in the darkest of times. One of them being your former partners, Investec. Started in the darkest times. Nando's is one of them, Bidvest, a whole host of household names. And by the way, that includes international groups such as, you've mentioned them, Netflix also started in the darkest of times. Technology wasn't there yet, etc., etc. So you've got to address these people, and you've got to say to yourself, there are opportunities in South Africa. And obviously, there are the risks. There's a security risk. We have delinquent, as you spoke to. You spoke about, what do you call it? Unsubstantiated expenditure, whatever you call it. We've got delinquent government, we've got delinquent controls, etc. But we're looking for the positivity. Where would you say is the most positive parts about South Africa and a reason to stay here, besides our beautiful weather, our magnificent women, and the wonderful things about our country? And there are plenty.
Farm, beaches.
She says living in Cape Town, absolutely, yes. But from an economic standpoint, where do you see the future of our country from a good perspective?
So 10, 15 years ago, I used to talk to friends who had taken jobs in Nigeria. And, they tell me these amazing stories of how well they were paid. But it was danger pay. They'd be paid in dollars. But they lived miserable lives, compound and security guards. It was awful. I remember the story of a guy who bought a Porsche, and he was so in love with this car. And a friend used to manage this car for him, and he bought this Porsche, and he didn't get to drive it for 10 years. And he came back, and it was an old Porsche, but he loved the Porsche, right? But I was thinking, what kind of a lifestyle is that? And then I look at South Africa today, and I think, wait a minute, right? So the friends would go for the opportunity. And I look at South Africa today, and I go, wait a minute, risk means opportunity. And I think the opportunities are huge because people are giving up on this country. New businesses could be started, maybe, I don't know. And it'll probably be at the SME level before, it'll be on the Altex board before it's something that we can invest in. There'll be massive opportunity for global companies as the rand weakens. There'll be opportunities for existing companies who want to seek those opportunities. I worry for people who give up and think the grass is green on the other side. Siobhan just commented about how beautiful our country is. Yes, there's crime, but there's crime in Brazil, there's crime in Argentina. Great, you get to feel safe in Saudi Arabia and Dubai, but look at everything that's going to be imposed upon you. You may feel like America, wow, look how safe you'll be there, but you're going to have a cop standing on your throat if you use a counterfeit bill. if you're the wrong color, of course, I didn't say that. So, every country has its problem. I don't think the grass is green. I talk to friends in the States, I talk to friends in the UK. They say, be very careful about what you're looking for. Be prepared to live in a flat that is maybe 20% of the size of the flat that you live in currently, if you want to be close to the city, whatever the case may be. So when I think about the opportunity, Menachem, the opportunity is not the one that I'm going to sit here and passively wait for. The opportunity is the one that I'm going to create, you're going to create, Siobhan's going to create, and hopefully the rest of you on this call are going to create with us. Because you stay, you fight, you don't let this country go to the wall. And South Africans, we've been here before. So you keep fighting hard, and you create those opportunities, you create employment. Why doesn't the government just say, you know what, guys, Sumesh, go out, start something. For every 2 jobs you create, here are the benefits. There are so many ways to get this country right. Cyril's the right man for the job. Unfortunately, he's the only man for the job right now. So we've got to get behind him. And we do have to get behind him. And I think as South Africans, we need to be more positive. Now, there'll be those of you on the call who are going, oh my God, this guy's a complete lunatic. It's a pipe dream. No, it's not. Okay, but what you do is you don't risk your assets for the dream and for the fight. You stay, you fight, you add your expertise, you add your intellect to the fight, but you diversify that portfolio. You come back to it's only 1% of market cap here. Yes, South Africa needs investments. Fine, let's buy some government bonds. Let's buy some infrastructure. Let's support. A portion of your assets can go to that. But you make sure that you're appropriately diversified, because I know what's going to happen. And I know why people are leaving. People are leaving because they feel rand-locked. And they're attributing being rand-locked to South Africa rather than emerging markets, because you're not being rand-locked. What you're suffering is higher inflation relative to DMs. But DMs have no growth. Think about what those people are running towards. Those people are running towards aging populations. They are running towards high debt to GDPs. The only thing that's hiding it right now are incredibly low interest rates. There's no growth. Let's leave out America. America's great at actually bringing immigrants in. But, under Trump, who knows? Sorry, Menachem. But America, you can at least kind of like bet on a little bit. But the other developed markets, there's no growth. People talk about this debt crisis and they look at debt to GDP. Take a look at the unfunded benefits, social security benefits of places like Germany and France and England, where those retirement benefits, those state pensions that are going to be paid, aren't going to impact your grandchildren. They're going to impact your great-great-great-grandchildren who are still going to be paying off the debt. The debt to GDP is nothing relative to unfunded social security benefits that are still coming down the pipe. So life isn't rosy there. We have the potential for growth. We have the potential for inflation. We just need to get it going. But if you've got your capital appropriately offshore, you don't have to feel like, hey, I'm getting poorer. You don't have to worry about, I can't send my kid to UCT or I can't send my kid to WITS. If you've already got the capital in dollars, you can send them wherever you want in the world. You don't have to get out and say, okay, I've got to start again. Appropriately diversify and stay and fight. So I know Johan Rupert has become a little bit bearish recently. He doesn't like the way the government has actually been behaving towards his efforts, but he had the right idea. Globally diverse, stay, fight, try and build something in this country. Because ultimately, if you want a safer life, if you don't want let's say the risks that exist in EMs, fine, you may have to leave. But if you're looking to build something, if you're looking to build a business, if you're looking to create wealth, you can physically do it here in terms of the opportunities while preserving the wealth that you already have by going offshore. Because trust me, it's much harder for the entrepreneurs amongst you to start a business in the US or the UK than it is to start a business here and actually achieve a reasonable amount of growth. So I'm bullish about staying and fighting, but I'm very prudent about how you diversify your capital. So there's a difference between staying and fighting and investing. Even though a lot of people would say, no, South Africa, we need your capital to get this thing going. I'll give them my intellect and my hours, but the capital I'm going to think very hard about.
Thank you. Steve?
Sumesh? Yeah, Sumesh, I mean, exemplary. Thank you so much for putting it the way you have. Thank you for your time, Siobhan, for managing this morning's session. I think the takeaway point is really that the risk is there, but risk does equal opportunity. It can be managed. It must be managed. We must have risk. We're sitting with some risk in our portfolios. Across all of the portfolios, there is risk. We haven't avoided it entirely. But as your point clearly was made, it is something that just needs to be managed. On your point on staying and fighting, ironically, yesterday we put out our monthly market update summarizing the month of May. And I used the analogy of success being similar to fighting with a gorilla, wrestling with a gorilla. And that you don't quit when you're tired, you quit when the gorilla's tired. And I think that, again, staying and fighting through the environment that we are seeing, the opportunity is there. But as you said, you don't have to have all of your money here. There's no reason why you and your money need to live in the same country. But again, from a bond perspective, the yields that we are seeing are very, very, very difficult to ignore. It's a point that we've been making for our clients for a long time, and holding much higher levels of government bonds of late, which are certainly paying, pardon the pun, but paying dividends. So thank you for your insight. Thank you for your time. Thank you for sharing your thoughts unequivocally and unreservedly. And it's great to have these sessions. We're going to be taking a week's break. Next week, we are sort of closing off today as as season 1 of our Vantage Point webinars. And we will be resuming with season 2 with some small tweaks and changes to the format. We're looking at a few opportunities to refine these sessions into season 2 of Vantage Point. So please do stay tuned. Keep an eye on your inboxes. The invites will be coming soon. The recordings of whichever of the webinars we've been able to record are available on our website. So if any of you want to binge over the next 2 weeks, borrowing the newfound word from Netflix, please do. And really look forward to seeing you all again 2 weeks from now. So, to all of you for your time, for your attention, and very much for your support on an ongoing basis. Thank you so much.
Thank you, Steve. Thank you very much, Siobhan. Thank you very much, Sumesh. Wonderful.